All right, so we are going to do IAS 37, which is provisions, contingent liabilities, and contingent assets. Okay, so there are three things here that I need to make sure that I clarify before we proceed. There is one, provisions. So provisions is one thing. Then there is contingent liabilities, the word contingent being the most important one. So there's contingent liabilities and contingent assets. So we are going to discuss these three principles in IAS 37. That is our main focus, for this chapter. But I want to quickly now go to the financial statements, our usual truest financial statements. So let's just quickly look at gonna do this. Okay, so you see in our financial statements, under equity and liabilities, under non-current liabilities, there is provisions here. Okay. So this is one of the areas where we are going to look at that type of provision. Other liabilities that we will talk about will be the trade and payables, also other liabilities that you'd find. But under current liabilities also, you'd find provisions as well. Okay. So there will be long-term in nature, and there's some that are short-term in nature. But provisions fall on the credit side of the financial statements. Um, I think if you remember now from your previous paper, we dealt with provisions. And for example, provision for bad debts, you would credit the provision. I will just illustrate this. So you will have two accounts that will be debiting and crediting. Okay, so you debit and you credit. So when we are making a provision for bad debts, for example, we are saying the bad debts is the expense. We'll expense bad debts with an X amount, and then we make a provision for bad debts. Okay. And that provision would then take the credit. So provisions are always credits. And that's why in the financial statements, our provisions is on the equities and liabilities side, which is the credit side, because the asset side is the debit side. Okay. So I just wanted you to have a view of these provisions that we are talking about, so that when we are now discussing the standard, you at least have an understanding, and also you bring your previous knowledge that you discussed provisions last time. This is where you find them in the statement of financial position. And now we're going to discuss how you arrive at the number 259 and 192. How do you arrive at this number that you then put disclose in your financial statements? Okay. So here we're going to talk about IAS 37. So like any standard, there are paragraphs that I said we will always find. The objective one, sometimes we'll find definitions, recognition, measurement, and disclosure. Same paragraphs. And these are the principles that they want you to understand. How do you recognize a liability? How do you recognize a contingent liability and a contingent asset? Then how do you measure them? And then also, how do you then disclose them in the financial statements? So we'll look at all of those steps in detail. So the first one is the objective. The objective of IAS 37, okay? The objective is to ensure that appropriate recognition criteria measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is then disclosed in the notes to enable users of the financial statement to understand the nature, timing, and amount of these figures. So the standard gives us guidance on how to recognize, measure, and disclose.
Yes.
You see, so it's the same three things that we will talk about in every standard. So we'll start now by recognition. Anyway, sometimes you find we have a scope paragraph. The scope is saying we will apply this standard to provision, contingent liabilities, and contingent assets, except for other things, because they are dealt with in other standards. So the standard only deals with provisions, contingent liabilities, and contingent assets. Now, definitions, right? So we are going to define some of these terms. Okay, so a provision is a liability of an uncertain timing or amount. In other words, there's uncertainty. It's a liability that we don't know when it will happen and how much it will be. That is a provision. So a provision is a liability of an uncertain timing or uncertain amount. We don't know when it will happen, and we don't know how much it will be when it happens. So that's why when we make provisions, we are using estimates. Okay, we call them best estimates. We are estimating that the bad debts will be 10% of our debtors book, but we don't know whether our debtors will be bad debts, and we don't know when there will be bad debts, and we don't even know how much will be bad debts. So what we do is make best estimates, and therefore creating provisions. So provision is a liability of an uncertain timing or amount. Now, what is a liability? Now, a liability is a present obligation, which means this obligation is right now. So it's a present obligation of an entity arising from past events, the settlement of which is expected to result in an outflow of resources. I think you did that in the conceptual framework. The first chapter we defined a liability. If you remember when we did the elements of financial statements. And then we said it is a present obligation. There must be an obligation for the company to settle, but that obligation should be present. In other words, it's there. We are not assuming. That's why a liability is defined as a present obligation. Then the events that cause this obligation, we call them obligating events. So these obligating events are events that create a legal or constructive obligation that may result now in a position whereby the entity does not have an option but to settle. Okay, because remember, if we get a legal obligation to settle, like for example, a CCMA case, we lost a case and there's a judgment against the company, then it creates a legal obligation for us to do it. We do not have an alternative but to settle. Those are examples of obligating events. So an event has to qualify for it to be an obligating event. Okay, so we are also now going to look at those items in more detail. Okay, now legal obligation is derived from the following. Number one, there must be a contract, which could be explicit or implicit. In other words, it could be in writing or it could be verbal. There must be an agreement between two parties. Or it must be arising from legislation. Let's say you are a company that is damaging the environment, and the environmental legislation says that after you are done, you should then restore the place. That is a legislative obligation. It's a legal obligation that is in the act. So when we make a provision to restore that land, it's based on the legislation. So that's an example, again, of a legal obligation. Or it could be operation of laws, depending on the industry that we are operating. Then a constructive obligation is an obligation that is derived from your actions. It's constructive as a result of your actions. Okay, whereby if we look at your past experiences or your past practices, or if we look at your policies that you publish either on your website, we can come back and hold you liable for that. Like, for example, we always say that if you buy an item, you have 7 days to return it. You know that, right?
Mm.
Yeah,
Mm.
they say 7 days return with a slip, isn't it?
What is it?
Yeah,
Mm.
that is constructive obligation. You may not have a contract with macro, but the receipt itself forms a constructive obligation for macro to take their or to change the goods if they are not functional. So that's an example of constructive obligation.
So does
So
it mean contracts are part of constructive obligations?
come again?
I'm saying, does it mean any form of contract? Because contract is an agreement. Is it a constructive obligation? Does it mean that?
No, a contract itself is a legal obligation.
Oh, legal. Okay.
Yeah,
Okay.
because
Okay.
there's a document that we are following. Constructive
Okay.
is behavioral. We may not have anything in writing,
Mm.
but your conduct is creating an obligation for you. Like, for example, when macro says 7 days, you can come back, we replace. That's constructive in that the way that's the normal way macro does things. So when you walk into macro today, you're not going to ask them, is the 7 days still applicable? No, it's their practice.
Mm.
So because of that, it creates an expectation from the other parties. And that behavior, that creates that expectation from other parties, creates a constructive obligation. So because of that, because of our behavior as a company, we create an obligation on ourselves that needs to be met. So then how do we deal with constructive obligations? That's what the standard deals with, okay? So as a result of this behavior, a company will then have a valid expectation that somebody expects us to behave this way. So sometimes they then provide warranties and other provision that they make in their books to say if we sell 10 televisions, right, 2 are coming back. So they make a provision for that. Even if the 2 don't come back, this provision will always be cycled and recycled all the time. That is as a result of their constructive obligation. So they create these provisions already in their system so that when the returns come back, they have set aside money for such returns so that it doesn't shock their financial statements that, oh no, we are getting broke. They just go and utilize the provision. It's not going to affect the expenses anymore. All right. So that's legal and constructive obligation. Now, we have defined a liability and we said it's as a result of a legal or constructive obligation. But what is a contingent liability and a contingent asset? So we'll start with a contingent liability. So a contingent liability is a possible obligation. Remember now, I want to quickly go back. All right. We said a liability is a present obligation, which means it's there. It's there right now. It's present obligation. We have a court order. We have a slip, a till slip from the customer. So it creates a present obligation. But contingent liabilities are possible obligations. So it's not there.
Okay.
It's not there. We don't have an obligation, but there's a possibility that we might have an obligation. So it's a possible obligation that arises also from past events whose existence can be confirmed by occurrence or non-occurrence of a uncertain future event. Again, not wholly in the control of the company. You see? So it's an obligation we have, but it's possible that we might pay this customer money back. But because there's no customer, therefore it creates a contingent liability. I want to give you an example. Again, let's go back to CCMA case. All right? If there is a report or a referral to the CCMA, that's one condition. And two, if there is an order from the court, from CCMA, for example, right? These are two conditions. If there is an order, this creates a present obligation, because the order comes with an amount and action that must be taken. And we know the amount and the timing by when we should have paid. So it creates a present obligation. But the fact that one of our employees has reported us to the CCMA does not create a present obligation. It creates a possible obligation. Okay? So it is confirmed by the occurrence or non-occurrence. It is confirmed by the case being for or against us. So we don't know, right? And the future is uncertain. We don't know whether the CCMA is going to be in our favor or in favor of the employee. Therefore, it creates a possible obligation, which creates a contingent liability. Do you understand? So in this case, it creates an obligation where it is not probable that economic benefits are going to flow. We are not sure. And also, we don't know the amount that we might pay. So if a company says that one of our directors has reported us to the CCMA and the issue is still in the courts, that creates a contingent liability, because we don't know the results of that case. Yes, the employee has reported us, but we can't tell whether it's going to be a case that we might win or not. Therefore, we say, number one, there is no amount. Okay, so I'm going to do this quickly. Let's say contingent liability. All right. So the first thing about contingent liabilities is that it is not probable that we might pay. So not probable that we may pay. We are not sure. It's uncertain. And secondly, the amount can not be measured reliably. Those are the two conditions. So a contingent liability creates a possible obligation, but we don't know how much it will cost, and we don't know whether we'll pay or not. So those terms or those notes, these notes that I'm giving you, will then help you to decide on whether we should make a provision or not. Okay. So that's a contingent liability. Then a contingent asset, again, is a possible asset that arises also from past events. Past events whose existence will be confirmed only by occurrence or non-occurrence of an uncertain event as well. Okay, so it's basically the same thing. We don't know whether we will receive the income or benefits from this contingent asset or not. And also we don't know how much it will cost as well. So just like a contingent asset and a contingent liability, it's probable that we may pay for a liability or receive benefits from an asset. Amount cannot be measured reliably for both. We can't measure the liability amount, we can't measure the asset amount. So those two are contingent liability and contingent assets. But you understand why we are talking about this and why it is important for us to be sure we know this in the next few slides. So here that we discussed one, a liability. All right. And we discussed contingent liability. And we discussed a contingent asset. So liabilities, we know, I mean, if we owe people, right? But contingent liability, I gave you the case of the CCMA case, which has only been reported, but not yet judgment not yet passed. You understand? Reported only. Then a contingent asset is, for example, an insurance claim. Okay? If you take insurance against your car, it creates a contingent asset. But the fact that you haven't been involved in an accident, that's where we say occurrence or non-occurrence of an uncertain event. Because you haven't been involved, because the uncertain event is the accident. So the contingent asset coming from insurance claim can only be present if there is an occurrence of an accident. So it remains a possible asset because you're saying, I am covered. I am covered. So it creates a possible asset that if my car is write off, they replace it. So you have a possible asset. But it depends on the occurrence or non-occurrence of an uncertain future event, which is occurrence or non-occurrence of an accident. If you're not involved in an accident, there's no asset. If you're involved in an asset, then there's an asset. But also, we can't tell how much the insurance will pay you because remember, they will have to come and assess, etc. So one, it is not probable that we'll get the benefits, and two, the amount is not determined. Okay, so liability and contingent liability and contingent assets. Do you have a picture now of what these three mean? Okay, good. Now, another term that you find in this standard is the onerous contract. Okay, so an onerous contract is a contract in which an unavoidable cost of meeting obligations under a given contract will exceed the benefits we derive from that contract. So an example here is, for example, when you lease a factory. Let's say you woke up tomorrow and you woke up, you had a dream and you were a billionaire. So you decide to say, my dreams never lie. I'm going to be a millionaire. So you take all your savings and say, I'm starting a business, right? Then you lease a factory for 5 years, and you know businesses. You can't lease over 12 months because it's not accommodation. You lease over a longer period. So 5 years, you go to somebody and you lease a factory, and then you buy equipment and machinery to start your manufacturing. So let's say you do this. We are in September, September 2024. You woke up highly motivated, spirits high. You're starting a business. Then December. Oh, let's just give you a chance that you make money in December. Then January 2025, you realize that people are not buying this thing that I'm making here, right? But you have already committed. to a lease of 5 years. So that lease agreement becomes an onerous contract. You understand? Because it is a contract in which you have unavoidable costs. You can't then cancel this lease. But if you continue to pay that lease, the amount of costs you are going to spend exceeds the benefits you are deriving from the factory. So then it becomes an onerous contract, or it's a burdensome contract. That's what it means, yeah. Okay. So this also creates liabilities for a company. So you would need to then find a way to treat an onerous contract in this case. Okay, so that's another example that creates liabilities.
Liability.
Okay, now let's go now to provisions. Okay, so there is a provision and then there is a liability. Let's go back to our financial statements. Trade and other payables are liabilities, right?
Mm-hmm.
And provisions are provisions. So what is the difference between these two? Okay. So provisions can be distinguished from other liabilities such as trade payables and accruals because there's uncertainty about their timing and amount. Remember, we said provisions, we don't know when and we can't tell how much. But trade payables, we know, we are certain about it because there is a supplier who gave us an invoice, and that invoice tells us by when we should pay it, and it gives us a date of delivery of goods, and it also gives us the amount. So that's the difference between provisions and liabilities in a nutshell. So liabilities, there's no uncertainty, but provisions come with uncertainty. That's why we have to separate the two. Trade and other payables, they are invoices already. There's a supplier, probably with a supplier contract as well, SLA. That's liabilities. Provisions, we have a lot of uncertainty about timing, when it will happen, and also uncertainty about how much it will be the amount. You see? That's why these two are also recorded separately. This one is actual amounts, right? Because we know them, but provisions are estimates. And we say,
Does it mean, does it mean in the financial statement provisions, it might not be there, or they are always in the financial statement?
we always make provision. Like, for example,
Mhm.
provision for depreciation.
Okay.
We have an accumulated depreciation. It's a provision account. We have bad debts, and we make provision for bad debts. So that provision for bad debts account sits also in the provisions ledger.
They are always estimates. Is provision
They are
always
always estimates.
Okay.
Estimates. Depreciation is an estimate. Because who said your cars are used in 5 years? You might even use the car 12 years. So you estimate that the life of the car is 5 years. We estimate that the life of a laptop is 3 years. We estimate that the life of a building is 20 years. All of those are estimates. But when you take care of your asset, service them, they might live longer, but we estimate. So provisions are estimates.
It makes sense.
Okay, good. So that's the difference between provisions and liabilities. One is certain because we have invoices. The other one is estimates. So all provisions then are contingent, okay? Because there's an uncertainty in the timing and the amount. But there's a way that we have to treat those provisions. Okay, because they are contingent, we know that we might not know the amount, we might not know when it will occur or not occur. So there is a way that we have to separate now contingent provisions and contingent assets and contingent liabilities. Okay, so contingent assets and contingent liabilities cannot be recognized in the financial statements. So that's why you don't even find anywhere where we say contingent asset or contingent liabilities, because they are contingent. They are dependent on occurrence or non-occurrence of a event. And that event that is uncertain whether it will happen or not happen. So they remain contingent. So provisions we can treat in the financial statements, but contingent liabilities and contingent assets, they cannot be recognized in the asset because they don't meet criteria for us to recognize them. One, we don't know how much it will be. Two, we don't know whether economic benefits are going to flow to the company or not. And three, we don't even have control of those contingent assets or liabilities. So they cannot be disclosed in the financial statements. What happens? I'm going to explain. So I'm going back now to a provision. So we provisions, we say that provisions, we at least with provisions, they may be uncertain about timing and amount, but at least we can estimate. Therefore, we can recognize provisions in our financial statements, because we are saying there could be obligation that we have to settle in the future. Like, for example, we are making provision for bad debts. All right. We are saying there must be a money set aside for us to take care of uncertain future events. But the question that you have to ask is that, if you see here, we say that it does not meet recognition criteria. So what is that criteria? What is this criteria that we have to say it meets for us to recognize it? So this is the criteria that we say. Number one, there must be a present obligation, which could be legal or constructive, all right, as a result of past events. So there must be a present obligation. Okay. And two, it is probable that future economic benefits are going to flow to the entity. Out of the entity for us to settle the obligation. And we can reliably estimate how much it will be. We can make a provision for that. Let's go back now to the CCMA case. Now, this time we have a judgment, right? And that judgment is passed on the 5th of September, 2024. What is happening here? This judgment that comes from the CCMA creates a present obligation, right? As a result of our legal or contract with the employee. If we settle this judgment, we are going to have an outflow of benefits, and the amount has been also written in the judgment later. Therefore, if we have all three ticked yes, we can then make a provision for labor costs, right? We can make a provision. In other words, we are saying maybe our legal department tells us that, guys, you dismiss this person and there's no way we are going to win this case. It creates an obligation. So we make a provision for that. Then we immediately go into our ledger. We debit the expense, labor cost, as a result of a CCMA case. right?
Mm.
And then we make a provision
Mm.
for the labor costs. Remember, we are not paying the employee. Let's say it's 2 million, right? Remember, we are not yet paying the employee. The legal department came and said, chances are we are losing this case. And the best estimate we will pay is probably 2 million, right? In this case, the legal department has confirmed that there is a present obligation as a result of our behavior, right? And it's probable that we are going to pay this employee, and we are probably going to pay 2 million. So if it meets all three criteria, because there's a judgment already, we can then make this provision, which is a provision. Now, let's say we did this, as I said, 5 September. Let me do this. 5/9/2024. Then the judgment then arrives. We have now to act. Then maybe on 30 November 2024, we have to pay the employee. But remember, we are not going to charge this against our profit and loss anymore because we've already made that provision, right? We are now going to debit the provision now because it was already there, right? And then credit the bank. At that time, we probably are going to pay 1.5 million because that's when we get the actual figure. You see, so the provision has helped us to not to affect our financial or shock our financial statements. We knew in September that there is a problem. So we made a provision for that. Why? Because it met the recognition criteria for us to do that.
Then, Blessmo, what happens if, for instance, maybe the estimated amounts for provision is not enough?
If we did not make enough provisions, it's also still fine. We will wipe out the 2 million first. Let's say it's going to be 2.5, right? So the 2 million will come from the provision, and our P&L, profit and loss, will then be affected only 500,000. It's different from having a shock of 2.5 unexpectedly. So provisions are there for us to manage the shock in the financial statements. So we are like being prudent to say, we know that we are going to incur these costs. Therefore, let's start make the provisions. So sometimes I want to show you how accountants then do it in a normal case. So this is September, right? October, November. Okay. So accountants will probably do this just to help us to manage so that it does not shock us in the financial statements. The accountant is going to say on the 5th of September, 2024, they are going to debit labor costs and save that money in the provision. Okay? And they are going to, okay, so debit, credit. So they are going to expense 600,000. They know it's 2 million, right? Then on the 31st of October, 2024, again. So it's helping us not to shock our financial statements. They'll probably say another 600,000. Right? So that by the time we get to, let's say, on the 30th of November, 2024, again, labor costs and provision as well, 800,000. What happens is we are spreading this liability and we are saving for this obligation that we know is definitely going to come. So instead of charging a whole 2 million against your profits, right? which will probably affect your profits. You could have been doing better. And then there was 1 month where everything went down because of this provision. So to avoid that, accountants would then make provision every month. Then when the judgment comes, let's say in December, they are going to reverse all of these provisions against the bank.
So when they reverse it, it becomes what?
When they reverse the provision, they become zero. Like in this case here, where they
And the
reverse
term for accounting,
the what?
the term, the right, I don't know, labeling.
Remember, it will be this journal here, this journal, where we say provision for labor costs, they are now being debited. And then we charge the bank against it. In a normal case, it would have gone to a labor cost expense account against the bank. But because we have been making provisions or preparing for this event to come, it does not shock our financial statements like once off. We have been preparing or making provision for that. But accountants choose now to just do the transaction once because they knew at that time they would rather shock the financial statements once, and then next month everything goes back to normal. And then when we make payments, it doesn't come through our profit and loss anymore. It just goes and utilizes the provision that we have been making. We have made.
Perfect.
Okay. So the idea behind making provisions is to prepare for these events that we didn't know. So provisions are then recognized through the financial statements. But if none of these are met, we cannot recognize a provision. Okay. So let's look at contingent liabilities now and contingent assets. So contingent liabilities, because they do not meet this criteria. Remember, with contingent liabilities, we are saying it's possible obligation. Outflow, we don't know. Amount, we don't know. Therefore, contingent assets and contingent liabilities are not recognized in the financial statements. What do? We just disclose them in notes to the financial statements. So instead of indicating them in our provisions, we put them in our notes to the financial statement to say, oh, by the way, we have a pending CCMA case that is still in the courts and we don't know the outcome. Therefore, we are expecting to pay this employee 2 million. But it's not in the financial, it's just disclosed in the notes. Do you understand the difference between the two? Provisions will affect our financial statements. We have to actually prepare the journals to make the provisions. But contingent assets and contingent liabilities, because there's a lot of uncertainty on the timing and amount, we disclose it in the notes to the financial statements. You understand how the two are treated?
Yes.
Yes. So for us to make the estimates, like I said, we use what we call best estimates. And with best estimates, we'll say we need a professional to do it. That's why we need chartered accountants to make provisions, because they are qualified accountants to make such provisions. In a case where we are not experienced in the area, like for example, we want to make a best estimate for a mining company. Accountants are not experienced in mining. Then we call experts to help us to provide the best estimate so that we make the right provisions.
Okay.
If it's a CCMA case, we need our legal department. So where we need professional practitioners to come and help, we request help. We are accountants. We are not engineers. Okay. All right. The other thing that you'll find also with provisions and liabilities is that there's a lot of uncertainty, and because of uncertainty, there is elements of risk. Okay, So because we are making estimates and we don't know what's going to happen, etc., we are trying to reach what we call the best estimate to make a provision. So there is risk. In this case, we'll always need to take into consideration that whatever decisions or estimates are being made, they are made under uncertainty. We could either understate or overstate our expenses or income because of that risk. Okay. But even though we are taking the risk and uncertainty into consideration, it does not mean that companies must then overstate their liabilities. You know, I mean, like for example, you don't want to pay your taxes, then you make a very huge provision that is not uncalled for. Okay, so the fact that we have to take risk into consideration does not justify creation of excessive provisions so that we overstate our liabilities or understate our assets so that we don't pay tax or it's not allowed to do that. We have to make to use the best estimates. Yes, risk is considered, but that's why we need professionals to make those judgments so that if in any case we are found to be against the law, it is the practitioner or the professional who then have to answer. Sometimes also because we are making provisions, there will be need for us to look at future values and present values. In this case, we'll do so much, about this when you do your board level, okay? Because you're probably making a provision about an event that's going to happen in 2026, for example. So what we always say is that today, 2 million is 2 million. But 2 million in 2026 is not 2 million because there are the effects of inflation. There could be deterioration, and we don't know. There could be redundancy in terms of our assets. We don't know. So all of these create risk, which we have to take into consideration. That's why we have to discount our cash flows, okay, to present value. Okay, so we that's a discounting. I will tell you this, but it's not examinable. We always say present value of a future amount is equal to the future amount divided by 1 plus the interest rate to the power n, depending on number of years that you are discounting back from. But this is not examinable. Like I said, this is what we then deal with at board level when you do your finance for decision making.
It's a formula.
Yes. So we also have to consider present values when we do these provisions if we are now dealing with future figures. Provisions also change. Like you told me right now, what if we did not make the correct provision? What if we over-provided or under-provided? So there's also changes in provisions. So what happens with provisions is that you have to either use the increase or decrease in provisions every year. Okay, so if you no longer need the provision, you have to reverse it through the profit and loss. And that's why when we do this, okay, that's why when we make provisions, we do this. Let's say it's a bad debts. Oh. Provision account, it's always a credit. So let's say we open a balance. We had a balance of 500. What we do is at the end of every year, we have to again estimate the provision. right? So if we estimate that the provision for this year, our estimate is probably 600, right? What we then include in our financials is the additional 100. So that our new balance is 600 and it goes again to next year 600. All right. So we only account for the difference between the new provision and what we already have in our financials. Let's say if it is 400, it means we have to write down. Okay, let's say again, we opened with 600 here, right? And then our current year, this year's provision is now 500. It means that we have to utilize the 100 to reduce that 600. So this would then be recognized to reduce the provision. So our estimate that we make at the end of the year becomes the new balance. So we compare it with the opening balance. The either increase or decrease in the provision is what we account for in the statement of financial position. So this 500 is the amount that gets to the statement of financial position. We just come here and insert the balance. Like in this case, last year it was 192. This year is 259. Here there's an increase in provisions. So it's probably chowing our profits because there's an increase. But if it is a decrease, it means that we have written back some of these provisions, and therefore it should also show it's an increase. I mean, it's a decrease in provision, which increases our equity, and our position gets much better as well. So that's basically how we account for changes in provisions. We estimate at the end of the year, compare with the opening balance. In the profit and loss or in a financial statement, we account for either the increase or the decrease in the provision. We do not say the full amount goes to the profit and loss. Like if we say 600 here, we do not charge this. We only charge the difference every year. All right. So you should have done this again in the previous paper, ne?
Yeah, I haven't done any. I was exempted.
Oh, okay. All right. Okay. So another area where we do provisions is where we are estimating that we are going to have future operating losses. Okay. If we think that we are not going to make money in January 2025, do we know the amount we are going to lose? Hmm?
I don't know the amount that we will lose.
We don't know because we are not in January. So we are estimating losses. So future operating losses shall not be recognized in the financial statements because they don't meet the definition of a liability. We do not know the amount and we can't measure it and we don't know when it's going to happen. Okay. But we expect a change in our assets. Therefore, we make provision for impairment. Remember, we did IAS 16, the last chapter, where we were saying provision impairment losses. We will then, it means that our assets are there's an indication that our assets have been impaired. Therefore, we prepare for impairment loss, but we don't make provision for future losses. Okay. Then we have also a restructuring cost as well, where we expect to restructure our business, and so we incur certain costs for the restructuring. So there are certain conditions that have to be met for us to account for restructuring costs. There must be certain conditions. So examples of restructuring costs could be we are actually selling our business, or we are terminating one of our business lines. That's a restructuring cost. Or we could be closing some businesses now other provinces. Or management structure, having a new CEO who's going to dismiss other managers. Or it could be a reorganization that will affect the way we operate as a business. So we can only make a provision for restructuring under certain conditions if the conditions are met. Okay. So
7 conditions.
these are the conditions. Number one, there must be a plan that has been signed off by the board of directors for that restructuring. So there must be a detailed formal plan. Okay. And it must be detailing the business or part of the business that is going to be affected, and the location of that business, a number of employees that could be affected, and if there's any expenditures, they must be in that plan as well. Okay, it should indicate when it should be implemented, and the management must have published it to the public that they are going to do that. So that's why we say they must have raised a valid expectation of the restructuring. The CCMA must have been brought in. They must have also taken part in the negotiation of the compensation for employees. You know, all those processes that we go through, they must have happened for us to start considering restructuring costs to make provision for that. Now, when a company now has done all of these things, okay, we then make a provision, just like we did with other provisions, because it has been established that the company is seriously considering restructuring. Employees who are going to be affected have been communicated to, and the compensation has already been agreed with the labor unions, and there's been seriousness. Therefore, we can make a provision for restructuring. Do you understand? Because number one, economic benefits are definitely going to flow, and we have a date when it's going to happen. So the timing is also certain. And the amounts that are going to be involved, we now also have them. So all three conditions have been met. That is when we can then make a provision. But if a company comes to us and say, we might restructure next year, we can't make a provision because there is no serious detailed plan that is explaining the process that needs to be taken. And they have not come and make a formal communication to the public. And they have not taken any actions to show that they are going to restructure. Therefore, we will not make a provision. But there are also costs that are not supposed to be included when we do restructuring in provisions. First one, when we are restructuring, we probably need to retrain our people and relocate them from one place to another. Those costs are not supposed to be part of a provision. Okay, we don't make provision for that. We actually have to incur the cost first and expense it through the profit and loss. Marketing costs, let's say we are now marketing the new company or the new structure. Those costs should be expensed as and when they are incurred. We don't make provision for that. Or if you are going to buy new systems or create new networks, all those costs should be expensed when they are incurred. Okay, so they are recognized if and only if they arise, not because we are planning to incur them. Okay, but the other ones that are in the detailed plan, we can make a provision for. So the last part that I want to discuss on this standard is how do we then disclose provisions in the financial statements? Okay, remember, like I said, there must be an opening balance and a closing balance and adjustments. So the standard says that There must be a carrying amount at the beginning of the period, and any additions or amounts utilized in the provision, which then creates the closing amount. I think I've shown you this, the way they would examine in your case. They wouldn't give you too much detail when they want you to account or disclose a provision. They just want to see an opening balance, a closing balance, and an adjustment. Is it an addition? Is it a utilization of the provision? Okay. So if you look in the statement of financial position for Truworths, for example, a capital commitment is an example of a provision that Truworths is making, right? Then they will give us the figures or how those provisions are going to be incurred. So look, this is an example of a restructuring. So there's capital commitments that have been done, but have been approved by the board. Do you see the difference now? It was approved and probably communicated. Okay, and then they give us the amounts that then they need to be provided for. Okay, and then they come and say capital commitments will be financed through cash generated from operations, available resources, and other financing facilities, and are expected to be incurred in 2020. This was 2019 financial statements, right? And they have got a date when it will occur. So this was part of their provisions. Then there's contingent liabilities. They said the group has no contingent liabilities. Litigation, remember CCMA and other litigation cases, there are no current or pending litigations. It has to be disclosed, because if there were any litigations, they were going to show contingent liability because they don't affect financial statements. They are disclosed in the notes. This is the example of the disclosure that I talked about, okay? And therefore, another one for sales returns. You know, when you buy clothes at Truworths, sometimes you go, I mean, you buy them on Friday, and then you attend your wedding on Saturday, then on Sunday
Not
you
anymore.
return it.
Not anymore. You know what? Now what the store did, especially with Forever New, I think they have noticed that now there's become a trend of people, go and take clothes and then return them.
Yeah.
So now there is this long on the side outside.
Mm.
So now the label, it's no longer inside. It's outside. It's a long label that you can't
Oh, you can't take
yeah,
off.
yeah. If you take it and it's sewed in, like it's like a proper label that it's outside.
Oh, and if you
Yes.
take it off, they will see.
You can't. They can't take it with that. It's more like
Part
yes,
of the
they
dress.
can't take it like yes.
Yeah, they knew. But previously now, because people used to do that, they would make sales returns provisions as well. Because
Mm.
they had made promises because of their conduct. They created this obligation as a result of their conduct. If you're not happy with it, bring it back. So they'll then make these provisions. But like I said, you start with a provision and then there's movements. So that creates the closing balance, right? Then again, this closing balance goes into the next year as opening balance. Movements again, and then you get a new balance. So what we account for is the movement, right? And the different provisions that have been raised or utilized to create a new balance again and again and again. Okay. And the policy of the companies, it is the group's policy to accept merchandise returns up to 30 days after the sale has occurred, or in the case of defective goods, up to 6 months after the sale, provided that the customer has retained proof of purchase. The amount of provision was calculated with reference to prior period sales return trends. And then they make provisions based on that. They are using that to estimate future provisions. You see. So it is a standard, yes, but it's a standard that we can actually prove it's in use. And this is an example of how you disclose provisions. First, it is the you have to show movement. If it is a contingent liability, you disclose it. It does not affect financial statements. But if it is a provision that has to go through the financial statements, and it's like, for example, restructuring or capital commitments, they have to be approved, and there's to be seriousness on the side of the company, and the details of the expenditure must be clear. Or if it is provisions that are made as a result of our conduct, we have to also disclose in the financial statements, but it is the movement that goes to the profit and loss. The balances will then be presented in the provisions in our statement of financial position. Right. Any questions? Is it clear? It was clear.
Yeah, it was clear, but I just want to know, because we mostly did theory rather than calculations.
Yeah.
Are these going to be part of the multiple choice? Do we have multiple choice in our exam?
Finance does not have multiple choice.
Oh, okay.
So sometimes when they bring it in the exam, the examiners will give you hints using the words that I've been using to say there's been a reported case at this, with the CCMA, but we are still waiting. So that you ask yourself, number one, is there a present obligation? Number two, do we know the amount? So there must be certainty in terms of timing and the amount that needs to be expended. Using that, we then make a provision. But if we can't establish that, it creates a contingent liability or a contingent asset, which instead of affecting our financial statements, has to go through the notes as a disclosure note. So that's what the examiners would then ask you to confirm. You would then say this was done right, or this was not done right. But it's a standard that you would find mostly in the board level exams.
Okay.
All right, but otherwise, that is the end of this standard.
Thank you.
Okay, so I will see you again next week,
Yeah, Tuesday.
Tuesday. All right, enjoy the rest of your evening.
Thank you so much.